last time we had talked about a synthesis of the analyses of the foreign exchange market and the money market. So if you remember that we had shown a negative relationship between the interest rate in Kazakhstan and the exchange rate. But we'll measure the exchange rate is number of penny per dollar. And then we added to the analysis the money market in which the vertical axis is working in the opposite direction. So, for example, here is the supply of tenge in Kazakhstan. And here is the money demand function. So you recall that as the interest rate is rising, the demand for money will go down. And consequently, the number of tenge involved is falling from, let us say, from point A. To point B. Go ahead if you have questions. So, for example, point A may be associated with a money quantity of 3 trillion tenge and B with 2 trillion tenge. So the only thing that bear in mind is that quantity is increasing in the lower end of the graph as we are moving down the vertical axis. Okay, so here's a puzzle for you. Good for fits introduction credit. Suppose that the National Bank worried for once about inflation. Reduces the money supply. How will this affect the exchange rate, the interest rate, and quantity of tenge? So I think we'll take maybe a couple minutes to think about this puzzle, and then we will reconvene as a class and solve it. However, there are an extra 2 points of extra credit for answering the puzzle first. So speak up if you have a solution. About 3 minutes, and then we will reconvene. Okay, good. How did you do? Would anybody like to attempt an answer to the puzzle? Let's see then. We begin at point A. The markets are in equilibrium in both sectors. In money, in the monetary market, the number of piggy that people want to hold equals the supply circulating in the economy. And we have determined the interest rate in Kazakhstan according to the interest parity condition, which says that we should offer an interest rate that is high enough to compete with the American interest rate, and also that will compensate for any depreciation expected in the tenge. Now, the national bid reduces the supply of tenge. What happens now? Well, notice that this affects the money market directly and the foreign exchange market only indirectly. So let's draw in the new money supply, maybe 2 trillion tenge rather than 3 right here. So we begin with the initial equilibrium A. Now money supply has decreased. So at A, we have the demand for money exceeds supply. Here is demand, and here now is supply. Remember that as we move up the vertical axis, shortages are actually decreasing. So we need to do something to bring the money market back into equilibrium. And the natural thing to think about is to increase the interest rate. So you remember that the interest rate is the opportunity cost of holding money rather than investing it in financial assets. So when the interest rate rises, people are tempted to take the money out of the total cases and spend it on bonds and stocks. Consequently, money demand is falling as we move from point A to point B. But as the interest rate is rising, people will want to buy more tenge because instruments, financial assets that are paying in tenge are worth more than before. Consequently, the demand for tenge is rising and the exchange rate is appreciating or falling. So here are the steps. The interest rate must rise to get rid of excess demand for the tenge. as it rises, the exchange rate falls. That is, the tenge strengthens, appreciates. Until we reach a new equilibrium at point B, and also at point C. There is C. So the changes that we can anticipate due to the central bank's new contractionary monetary policy is that we have a fall in the exchange rate, the tenge strengthens. Money in property in circulation decreases since the central bank has cut back on the money supply. And the interest rate rises as well. So this may be helpful if the bank's purpose is to avoid inflation, because the higher interest rate discourages real investment. Thus averting increases in prices. But perhaps at the cost of the pain of recession. So there is the dilemma for the national bank. Do we want to have inflation, or do we want to have a strong economy today? Questions about the synthesis of foreign exchange and monetary markets. Okay. If not, then we'll move on. So with that background on how the interest rate interacts with the exchange rate, let's go back to our discussion of short run and long run assets. The total the books convention of referring to all assets as bonds, even though technically that's really not correct. Usually a bond has a maturity of at least 1 to 5 years. But let's not worry about that. Then we observe that as a rule, the interest rate in the long run exceeds the interest rate in the short run. So we may ask Why does it occur? And as well, what is the relationship, if any, between short run and long run interest rates? So let's say investors, financial investors, can buy and hold either short run or long run assets. So we would expect to see them holding both kinds of assets only if they're offering the same expected return. So this seems to suggest that the long run interest rate, that is the interest rate on a long run asset like a 50-year bond, that rate of return is the average of short run interest rates. So for example, you can hold either a 2-year bond or 2 1-year bonds in succession. That is, for the long run bond, maturity ends in 2023, or you could buy a 1-year bond today, let it mature in 2022, and then reinvest the money made on the first 1-year bond into another 1-year bond that will mature in 2023. So if you hold both kinds of bonds, the one long run bond or the 2 short run bonds in succession, you must expect the same return. The long run interest rate equals the average of the short run interest rates. And that should make sense, perhaps. For example, suppose that you expect an interest rate of 9% on a 1-year bond that you hold today. In 2021, and a rate of 11% on a bond issued by next year. Then you would be willing to hold a 2-year bond rather than more 1-year bonds, only if it's expected rate of return is the average of the rates on the 2 1-year bonds of 10%. So that's the idea. But let's see if it makes sense in a more careful analysis. So let's keep things simple. We will treat 2 years as the long run and 1 year as the short run. And we want to compare the returns on the long run bond to those on the short run bonds. So let's begin with the single 2-year bond or long run asset. And again, to keep it all simple, suppose that the bond is purchased for only $1. So for this bond, the interest rate at the end of the second year we will call this I2T. 2T just means the second year. Then we will understand this as an expectation. Because since we cannot foretell the future for 2023. So the return on the bond now an expectation involves holding the principal and the interest in the account until the end of the second year. And then to get the return on the bond, people subtract the initial expense of $1. So writing out the actual return at the end of the second year, but multiplying through by our terms, we have in the probability expression two interest rates in the second year. Remember that we have not cashed in the bond at the end of the first year. We keep it in the 2-year asset. And then the interest rate verbs and then again subtracting for the initial investment in the bond. So the overall return on the 2-year bond is twice times the interest rate in 2023. And this the square of that interest rate this is not only the absolute return on the loan bond, but also the rate return, the rate of return, because divided by 2 by 1 to get the rate. Okay, the interest rates, especially these days, are very low. So squaring the interest rate is a very small quantity. If it is 1%, then the square of that return is 100th. I should say 1,000th of a percent. So since the interest rate in year 2023 then squared is a small amount, let's ignore it. This is theory, right? Thus, the return or rate of return on the home run asset is about 2 times the interest rate in 2023. Okay. So now consider instead not the purchase of one long-run bond, but instead the purchase of 2 one-year bonds in succession. So this is the short-run investment as opposed to the long-run investment. We buy one one-year bond today in 2021. And reinvest it rather than pass it, reinvest it in a new one-year bond in 2022. And finally, people cashed it in 2023. So there are 2 equivalent ways of earning return on $1 of financial investment. Either you should spend the $1 on the 2-year bond or just keep reinvesting it in 2 one-year bonds. Okay, so you invest $1 now. And then at the end of the year, in 2022, we have in our asset $1 plus the interest rate earned in this year. So the IT see the interest rate for 2021 to 2022. We will put that to be known. Now, rather than cash in that bond, people reinvested. In a second one-year bond that will mature in 2023. So the expected return on that bond is the amount that we had from our first one-year bond of 1 plus the interest rate in 2022. And then at the end of the second year, in 2023, we will realize on that bond the principal. This is not right here, plus interest earned at the expected rate of the interest rate expected for 2023. Then, then again, we subtract the initial cost of the bonds to $1 to be initially invested. So writing out that return on the 2-year bonds as a quantitative expression we have a product for the interest rate at the end of the first year, and then the expected interest rate at the end of the second year. And then subtracting once again to the initial investment. So the return on the 2 1-year bonds is the interest rate at the end of the first year and I'm sorry, I should add the expectation as well in the quantitative expression. Okay. So now let's offset the ones and recognize that this product right here of an actual and expected interest rate is going to be very small as before. So let us ignore that amount. Then the return or the rate of return on the 2 1-year bonds amounts to the interest rate earned after the first year and the expected interest rate earned after the second year. Okay, because you will hold both the long run and the short run assets only if they have the same expected return. So the return on the long run asset is 2 times the interest rate. Then the return on the 2 one-year bonds is the interest rate after the first year, and then the expectation at the end of the second year. So the interest rate earned on the bond over the 2 years is equal to the average of the short run interest rates. That recognizes that bonds is an expectation. That is the interest rate on the long run bond, the interest rate that is realized in 2023 equals the average of the 2 short run interest rates, recognizing that the second year interest rate is not known for sure today, but is instead an expectation. Again, if the interest rate after the first year is 9%, and the expected rate at the end of the second year is 11%, then we would hold the 2-year bond only if the expected interest rate of 10%. Notice that the long run 2-year bond has only one interest rate, so does not bring the cash in the 2-year bond until after it matures at the end of the second year, just one interest rate over that time, annual interest rate. So now that we know the relationship in returns on the short run and the long run assets, it's very interesting to ask, why is it the case that long run interest rates are usually greater than short-run rates. So, for example, in the United States, in 10-year Treasury bonds, is about 1.5% on Treasury bonds. Higher than on 1-year assets, which have interest rates that are pretty close to zero these days. Though our result suggests one reason. The interest rate on the 10-year bond is the average expected rate on annual bonds. So we must expect interest rates to be rising in the future on short-run bonds. So, for example, we expect a 9% interest rate on a bond, a 1-year bond. In 2022, and 11% is expected on the 1-year bond in 2023. We expect the short-run rate to rise from 2022 to 2023. Why? Continue. Well, maybe we expect inflation to rise in the future. We are looking at nominal interest rates. And the question is then, why are we so wedded to that expectation of increasing future inflation? Any ideas? Any speculation? Maybe we think that central banks are willing to create more and more money in the future, which pushes up prices, the price level. So there is more speculation for the reason why long-run assets have higher expected returns than short-run assets. I'm out of time, so I will stop there